We baby boomers are all too aware of the multiple threats that could put our retirement savings in peril. We've talked about risks such as longevity, that's increased life expectancy, inflation eroding your purchasing power, as well as risks associated with the possibility of rising taxes, and of course, the unpredictability of the stock market. It's the over-reliance we may put on our stock portfolios for our short-term financial needs that creates one of the most overlooked threats to retirement security. It's known as sequence of return risk. Simply put, sequence of return risk means you may be selling shares from your retirement portfolio to provide cash at a time when the market is down, and you essentially lock in your losses by selling at or near the bottom without giving the market the time that's necessary for it to recover, and then those shares potentially grow again. Many boomers subject themselves to the sequence of return risk because they have a plan where they take systematic withdrawals from their portfolio for their retirement income. Some financial planners advocate having a year or two cash cushion that you can spend without tapping your stock portfolio. But if a down year in the stock market is followed by another, boomers who use a systematic withdrawal strategy risk depleting their resources. And what if we have another stretch of 3 consecutive down years, as happened from 2000 through 2002, or 4 straight years like it did during the Depression? Here's the bottom line. Rather than a systematic withdrawal strategy, it's better to have a plan in place that allocates money to safer, more liquid investments for several years and leave the stock portfolio alone for the long run.